Every year, millions of Americans pay more tax than they need to, not because they did anything wrong, but because they missed deductions they may have been allowed to claim. And the truth is, the tax code is full of rules that sound simple at first, but get confusing fast. That is why so many people overlook legitimate deductions, especially if they are filing on their own, working a side hustle, running a small business, paying student loans, or trying to keep track of family expenses. In this video, I'm going to walk you through 11 tax deductions that many Americans either forget, misunderstand, or never realize they may qualify for in the first place. I'll explain each one in plain English, who it may apply to, and the mistakes people commonly make. And just a quick note before we start, this video is for general education only, not personal tax advice. Tax rules can change, and whether a deduction applies depends on your specific situation, so always check the latest IRS guidance or talk to a qualified tax professional if you're unsure. Also, one important reminder, a tax deduction lowers your taxable income, which may reduce how much tax you owe. That is different from a tax credit, which directly reduces your tax bill. A lot of people mix those up, so keep that distinction in mind as we go. Let's start with one that many people know by name, but still fail to use correctly: the deduction for traditional IRA contributions. If you put money into a traditional IRA, you may be able to deduct some or all of that contribution on your tax return, depending on your income, your filing status, and whether you or your spouse are covered by a retirement plan at work. This is one of the easiest deductions to miss because many people wait until tax time and assume it's too late, or they think retirement contributions only matter through a workplace plan like a 401k. In many cases, you can still make an IRA contribution for the prior tax year up until the tax filing deadline, not including extensions. That means some people have a last-minute chance to reduce taxable income while also saving for retirement. But this deduction is not automatic for everyone. Income phase-outs can apply, especially if you are covered by a plan at work. So the key takeaway here is simple. If you contribute to a traditional IRA, make sure you check whether that contribution is deductible, because many taxpayers leave this one on the table. Next is the deduction for health savings account contributions, also known as HSA contributions. If you have a qualifying high-deductible health plan and you contribute to an HSA, those contributions may be deductible if they were made with after-tax money, or excluded from income if they were made through payroll. This is a powerful tax benefit because HSAs can offer a triple advantage in the right situation. Contributions may reduce taxable income, growth inside the account can be tax-free, and qualified medical withdrawals can also be tax-free. But people still miss the deduction because they do not realize they are eligible, or they lose track of contributions made outside payroll. Some people also confuse HSAs with FSAs, which have different rules. If you made direct contributions to an HSA instead of through your employer, that is where this deduction can really matter at tax time. Just be careful. Eligibility depends on having the right type of health insurance coverage and meeting IRS rules for the months you contributed. Another commonly overlooked deduction is student loan interest. If you paid interest on qualifying student loans, you may be able to deduct up to the allowed annual limit, subject to income limits and other requirements. This applies even if you do not itemize your deductions, which is one reason it gets missed. A lot of taxpayers assume they have to itemize to get any education-related tax benefit, but that is not always true. Others do not realize that only the interest part is deductible, not the full payment. This can help recent graduates, working professionals, and even some parents if they are legally responsible for the loan and meet the rules. Usually, lenders send Form 1098-E if you paid enough interest during the year, but even if that form does not arrive, you still want to verify your records. The most important thing here is to make sure the loan qualifies and your income falls within the rules for the deduction. Now let's talk about a deduction that matters a lot for self-employed workers, freelancers, and small business owners: self-employed health insurance. If you are self-employed and you pay for health insurance for yourself, your spouse, or dependents, you may be able to deduct those premiums, subject to IRS rules. This is a big one because health insurance can be expensive, and many people with self-employment income do not realize this deduction may be available to them. It can apply to sole proprietors, partners, and certain shareholders, depending on the structure and circumstances. But people miss it because they either mix personal and business expenses together without proper records, or they assume insurance is only deductible as an itemized medical expense. In some cases, self-employed health insurance is treated differently and may be claimed without itemizing, if the rules are met. One major thing to remember is that you generally cannot take this deduction for any month you are eligible to participate in an employer-subsidized health plan, whether through your own job, a spouse's job, or another source. So this deduction can be valuable, but it needs careful attention to eligibility. The next one is the home office deduction, which is probably one of the most misunderstood deductions in the tax world. Many people either avoid it completely because they are afraid it will trigger an audit, or they claim it incorrectly when they do not qualify. Here's the simple version. This deduction is generally for people who are self-employed and use part of their home regularly and exclusively for business. That regular and exclusive rule is the part people often miss. If your kitchen table is sometimes your office but also your family dinner space, that usually does not meet the exclusive use test. But if you have a clearly defined part of your home used only for business, you may qualify. There are generally two methods to calculate this deduction: a simplified method and a regular method based on actual expenses. The deduction may include part of your rent, mortgage interest, utilities, insurance, and other home-related costs, depending on the method used and your situation. This can be a real tax saver for freelancers, online sellers, consultants, and other small business owners. But it is not for everyone, and in general, W-2 employees working from home do not get the same federal deduction just because they work remotely. That is one of the biggest misunderstandings people have. Another deduction that many taxpayers miss is business mileage. If you use your car for qualified business driving and you are self-employed, you may be able to deduct those miles using the standard mileage rate, or in some cases, actual vehicle expenses if allowed and properly tracked. This deduction gets missed for a very simple reason. People do not keep records. They remember the big trips, but forget the daily driving that counts, like going to meet a client, driving to the post office for business, picking up supplies, or traveling between business locations. At the same time, commuting from home to your regular workplace is generally not deductible, and that is another area where people get confused. The IRS expects records, so this is one of those deductions where documentation matters a lot. A mileage log, app, calendar, or detailed records can make the difference between a valid deduction and one you cannot support if asked. If you use your car for a side hustle, contract work, delivery work, real estate, consulting, or any other business activity, this is one to pay close attention to. Let's move to educator expenses. If you are an eligible educator, you may be able to deduct certain unreimbursed classroom expenses, up to the amount allowed by law. This one is often missed because teachers and school staff are used to buying things for students out of pocket, and they may not realize some of those costs can count. This could include classroom supplies, books, certain materials, and other qualifying items used in the classroom. The rules depend on your role and whether you meet the IRS definition of an eligible educator, so it is important not to assume every school-related purchase qualifies. Still, for teachers who regularly spend their own money to support students, this is one of those deductions that should not be ignored. It may not be the biggest tax break on this list, but it is one of the most practical and most commonly forgotten. Next is charitable giving, but this one needs a careful explanation because the rules can be confusing. In general, charitable contributions to qualified organizations may be deductible if you itemize deductions on your tax return. That means not everyone gets a benefit from charitable donations at the federal level every year, especially if they take the standard deduction instead of itemizing. This is exactly why so many people get confused. They donate money, clothes, household goods, or other items and assume it will automatically lower their taxes. It may, but only if the donation is made to a qualified organization and you meet the rules for claiming it. Good record keeping is critical here. Cash donations usually need bank records, receipts, or written acknowledgments, and non-cash donations often need documentation of what was donated and its condition. The biggest mistake people make is giving without saving proof, or overestimating the value of donated property. So yes, charitable contributions can absolutely be valuable, but only when claimed correctly and supported properly. Now let's talk about medical and dental expenses. This is another deduction that exists, but many people misunderstand how hard it can be to qualify. In general, you can only deduct qualifying unreimbursed medical and dental expenses to the extent they exceed a certain percentage of your adjusted gross income, and only if you itemize deductions. That means this is not a simple dollar-for-dollar write-off for everyone. Still, people with high medical costs in a given year may overlook it completely because they assume medical expenses are never deductible, or they do not realize how many qualifying expenses they actually paid. Depending on the rules, qualifying expenses may include doctor visits, hospital care, prescriptions, certain treatments, medical equipment, and some other healthcare-related costs. But cosmetic procedures and reimbursed expenses are generally treated differently. This is one of those deductions where keeping receipts and year-end summaries can really help, especially if you had a major surgery, ongoing treatment, or a year with unusually high healthcare spending. Another deduction that can surprise people is the deduction tied to self-employment tax. If you are self-employed, you generally pay both the employee and employer share of Social Security and Medicare taxes through self-employment tax. The good news is that you may be able to deduct the employer equivalent portion when figuring your adjusted gross income. A lot of side hustlers and freelancers miss this because they are focused on income and expenses and do not realize part of the self-employment tax itself creates a deduction. You do not have to itemize to benefit from this one. It is built into the tax calculation if your return is prepared correctly, but it is still worth understanding because many self-employed taxpayers have no idea it exists. This is also a good reminder that if you have freelance income, gig income, consulting income, or business income on the side, your taxes may be more complex than you expect, and deductions connected to that income can make a real difference. Here is another one people often forget: penalties paid for early withdrawal of savings. If you withdrew money early from a certificate of deposit or another time-based savings account and paid a bank penalty, that penalty may be deductible. This is not something most people think about at tax time because it feels like a banking issue, not a tax issue. But banks often report this information on your tax forms, and it can reduce taxable income in the right situation. It is not the most common deduction on this list, but it is exactly the kind of small, technical detail people miss every year. If you closed a CD early, moved funds before maturity, or paid a penalty for taking money out of a savings product too soon, this is worth checking in your tax documents. The 10th deduction to know about is alimony, but this one comes with a major warning. The federal tax treatment of alimony depends heavily on when the divorce or separation agreement was executed and whether it was later modified. Under current federal rules, many newer agreements are treated differently than older ones, which means some taxpayers think alimony is deductible when it is not, while others may have older agreements where different rules still apply. This is exactly why you should never assume based on something you heard years ago. If alimony applies to your situation, the date of the agreement matters a lot. The rules here are very specific, and it is smart to review the actual agreement and current IRS guidance or get professional help before claiming anything related to alimony on a tax return. And finally, one of the most overlooked deductions on this list is the choice between deducting state and local income taxes or state and local sales taxes, if you itemize and if the rules allow it. Many taxpayers just go with whatever software fills in automatically and never stop to compare. But in some cases, especially if you live in a state with no income tax or made large purchases during the year, the sales tax deduction may be more valuable than the income tax deduction. You generally cannot claim both in the same way for this purpose, so the choice matters. This comes up a lot for people who bought a car, boat, major appliance, or made other large taxable purchases. Again, this deduction is subject to broader state and local tax limits under federal law, so it is not unlimited. But it is still something people miss because they do not realize they have a choice at all. Now, before you start trying to claim every deduction on this list, there are 3 quick mistakes you want to avoid. First, do not confuse deductions with credits. They are not the same, and a credit usually works differently by reducing your tax bill directly. Second, do not assume that every expense is deductible just because it feels work-related, school-related, or health-related. The IRS has specific rules, and the details matter. Third, keep records. Good tax records are what turn a possible deduction into a real one. That means saving receipts, mileage logs, contribution statements, insurance records, loan forms, donation acknowledgments, and anything else that supports what you are claiming. The bigger lesson here is simple. The tax code rewards people who understand the rules and document their expenses. Most Americans do not miss deductions because they are careless. They miss them because the system is complicated, the language is technical, and many tax breaks only apply under specific conditions. That is why learning the basics can save you real money over time. If this video helped make taxes a little easier to understand, subscribe to SimpleTax Explained for clear, practical tax tips in plain English. And in the comments, let me know which deduction surprised you the most, or which one you want me to explain in a future video. Thanks for watching, and I'll see you in the next one.